we are live. Fucking finally. Let's check it out. Test. Oh, not even connected. Yeah. Alright. Let's start this shit up. A little late today, but yeah. I will explain. Over like 80p. What are we on? The 20th? Alright. As you can see. Wait. Let me make sure I can see. Focus. 6 to 6. Now, why I didn't start the stream earlier is because I'm trying to get a second job for the summer or 3 months. Doesn't have to be the summer, but went for a job search, and yeah, I wasn't really looking at the charts. I anticipated this, as you can see, from the beginning of the week. However, I'm an infant, and I don't have a lot of tape reading, so I don't know how these type of things are gonna roll out. But now I know. Well, now I don't know, right? But like now I've gained more experience. Yeah, 9:30. I was I'm not gonna explain my thought process or anything, or what I was doing, but I was busy. Even though I was about to, until I realized there's no point of it, because this is the point of it right here. This is the point of the stream. Alright, let's continue this shit.
Greater than, yes. And again, we're focusing on nailing down where the high.
More money in your
Motherfucker.
pockets, safer communities here in Wisconsin, and government that works for working people. Check out my website to learn more about what we're doing for you in Washington. Paid for by official funds authorized by the House of Representatives.
Imagine if Michael Jordan personally coached you in basketball, or if Cristiano Ronaldo taught you how to dominate the field. Now imagine having the world record holder for prop firm payouts mentoring you. That's what this is. Why do so many traders pass only to blow the account right after? You've probably been there. You pass the challenge, then boom, you blow the funded account. Or worse, you just can't stay consistent long enough to get real payouts. So it's back to square one. Another reset, another restart. And the cycle never ends. Here's the brutal truth. There's too much noise in the market right now. You don't know who to trust. Everyone's claiming they've cracked the code, but most of them, they make their money from selling education, not from trading. You need to learn from someone who's actually in the game, someone whose main income is trading, not courses. That's what separates the pros from the posers, and that's why most traders never get consistent. Hey, my name's Kyle. I'm the world record holder for the highest prop firm payout in history. I've been publicly featured by some of the top prop firms worldwide, recognized as one of their most profitable traders. There's a huge issue in the trading education space right now. Everyone's just trying to make a quick buck, teaching others how to trade, while they're not even full-time traders themselves. And that's why I built a different kind of mentorship. This isn't a one-off course full of recycled content. It's a real-time, real-world trading mentorship, built by someone who still trades, still withdraws, still lives off of the craft. And we don't stop at helping you pass. We take you all the way to consistency. Withdrawals.
Oh, I
Right,
fucking
over
hate that
there,
nigga.
over
I fucking
there.
hate his fucking voice, bro. I fucking hear it all the time.
Okay, and we always look at the central bank dealers range in terms of using the spread of the wick to wick, high to low range between 2 p.m. and 8 p.m. New York time.
Sure.
And I like to look at the bodies, highest high in the form of an open or close, and the lowest low in the form of an open or close, not the wicks. So I get the range in the bodies, but then I also do it on the wicks as well, because you want to do everything you see in this teaching here. You're going to do the same thing using the wicks, but I'm teaching it through the use of the bodies, because that's predominantly what I go to first. I get the ranges and projections and measurements based on the bodies of the candles.
Okay.
Okay, so now we get to the part where most of you have been waiting for a long time to learn this.
Yes,
And to be
yes.
quite honest with you, I'm not sure why I'm doing it. It's one of those things that I've kept for a long, long time, and I promised that you would learn it in this mentorship. So, if you are ever in the sharing spirit, if you're ever in the Robin Hood mentality, you want to give to everyone else that aren't a part of this mentorship, this is one of those things you just really, really, really want to keep to yourself. It's not common knowledge. It's not out there anywhere else. Believe me, when you start looking at it and seeing it, it's mind-boggling. It really is mind-boggling how precise you can get. But we
I haven't even
showed
done that
the standard deviations
on
and the
my own
application of their
time, or on
okay?
my own.
And obviously, it looks like just
I haven't done
grabbing
that on my own.
the best ones and doing
But it is
that.
mind-boggling.
There it is. It's as simple as that, and it's all pure hindsight. But if you look at what I'm going to show you in this teaching and go back to the analysis during the time when we were looking at the market like this, you'll see the levels that I had given on the chart index. They're all there. Okay. So we're going to take a look at every one of these examples with the exception of the 58 pip central bank dealers range, because that's a NIX. We don't do anything for that particular day, but we will comment on that when we get to that second example. Okay, so let's go out to a daily chart, and I'm going to ask you, what do you see here?
Shut the fuck up. Motherfucking ICT asking me what I see. Nigga, I'll tell you what I see. I'll tell you exactly what I see. Alright, do this shit. What I see is I can't see the fucking date, so I can't tell if this is IPTA. Wait, daily chart. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Boom. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Boom. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Boom. Okay, bet. 1 right here. 60 days right here. 40 days right here. 20 days. So IPTA low. Where did I say that 60 days was? I think it was over here. High. Break that into he kind of already has it on the order block right there. discount premium quadrants. Uh, Premium quad quadrant split into a premium and discount. I'll give it about right here. Okay. We are in an overall premium market. We just got out of a discount range in the bottom. Okay, now that I know where I'm at, I see a fair value gap. In a discount. In a overall premium market, but however, it's going in the fair value gap is in a discount range in overall premium market. I think that's how I should word it. Okay. Top of that, order block. Wait, I actually I wouldn't know. Maybe he'll give me some insights on that. But on top of that, we can even break that down over here. We have a rejection block right here. As it hits the order block, rallies, goes into the bearish order block, reaches for the rejection block but doesn't make it, rallies, makes another rejection block, and it being the bottoms ultimately runs the sell stops, and after the body touches the order block, rallies. But I beg to differ that was the reason why it rallied. I think it just made a liquidity void. That's why it rallied. It moved down way too fast, as we also saw here, but it didn't run out. It didn't run the buy stops over here. Over here, it's reaching for it.
Okay, I'm drawing your attention to a specific level with that little trend line, blue line. And that's the segment of price action that we're looking at in terms of those examples. And I'm going to highlight that little area in this white box. Okay, so we're looking at this whole entire reference point here. And again, I'm going to count you to go back to the time when we were talking about the cable and analysis and all of the charts that were shared. Okay, go back and look at that. So none of this stuff is cherry picking, okay? So what we're doing is we're looking at the marketplace using the PD array matrix, and we're blending it with time and price theory. So we're looking at if the data ranges, we're looking at PD array matrix, are we in a premium or discount? The market trades down in the lower range of that white rectangle until it hits a bullish order block. What I've done there is I've taken the Sunday candle and the Monday candle, blending that small little Sunday candle and Monday candle into one candle, blending the two bodies together. And I got a measurement of that, and I projected it across the chart. And you can actually go back and look at your notes and look at the forum. And I counsel you to download the charts every day. I do them because you can keep track and see that I don't make any changes. I don't go back and re-edit them. You get them as I see it. That way you can compare what I'm explaining to you here was exactly outlined in terms of PD arrays specifically. I even tell you that's a mean threshold of the bullish order block there. So
Real
price
shit.
hits that level,
Real
creates
shit.
the first of 3 up candles. And now we're going to go into those examples and break it down.
If you live here in Wisconsin and you have an old, cracked, or stained garage floor and you've been looking to do something about it for a while, we have a promo going on right now where we are taking 60% off every project we do, or finance your transformation with 0% interest for 60 full months. It has a lifetime warranty. It takes 1 day to install, and it looks amazing. If you're interested, if you'd like more info on this, click below and we'll text you the details.
Fucking phone died. Oh well.
Okay, folks. Okay, here we are. We're at that point where this stuff starts to get really, really interesting. So, when we look at these examples, okay, this is where the price has traded up into a premium on the daily chart. And we did our standard deviations, okay, and we see price that was on the daily chart in a premium at this time.
You're right.
We have a bullish candle right for the down move here. That gives us a bearish order block. That low comes in at 125.93. The high comes in at 125.97. So it trades up into the body of the bearish order block. Standard deviation of 2. Price extends up to the standard deviation, right to the pip, and starts to trade off for the rest of the day. When we have the standard deviation arrived at, based on a PD array, in other words, we're looking at a premium PD array, bearish order block, price in a daily premium, hits it in London, have a protractionary state in the marketplace, Judas swing in London, goes right to the pip and trades lower. The question is how low will it go? Well, you have to look at the range that was created by the central bank dealer's range protractionary state. In other words, how much of a standard deviation did we see? Because that becomes the known range to work with, and it becomes our multiplier as well.
Okay.
So when the market looks to fill the numbers, and I'll tell you what that means when we get to it, we use this reference point here. So it has to actually, the actual standard deviation
3.
range that we use for the central bank dealer's range and all the standard deviations it uses to make the high or low of the day in London, that becomes your measurement. Okay, so what we have here is the market showing us a
Excuse me.
midnight in New York candle, vertical line, and then 1800 or 2 o'clock in the afternoon, New York time. And again, each day, midnight New York, 2 o'clock in the afternoon, midnight New York, 2 o'clock in the afternoon, midnight New York, 2 o'clock in the afternoon. Okay, and I'm going to give you the London kill zone reference points now. And this is that daily premium PD array here. So the price trades up into it and starts to sell off. So in this time element here, this gives us our London close time of the day. So this candle here starts it. This is the middle of the London kill zone close. And then we have this candle here, right there, that creates the projected London close time window. But then we have ultimately 2 o'clock where we actually see the close of our highest point In other words, usually the higher low, even on a really long-winded trending day, 2 o'clock usually caps the higher low of the day. If we continue through London close kill zone, or basically if we go past noon New York time, we look for it to go to 2 o'clock and dribble down or run up until that specific time of the day. So all of these days, we don't have anything on this day here because the central bank dealer range was 58 pips, regardless if we used the wicks as the high and low or if we use the bodies high and low. It doesn't make a difference. The point is it's still too much of a central bank dealer's range to use for our projections in here. So we have to skip on this day here, but we use other tools, which we'll explain in a moment. The daily bullish order block, price trades down into that on this big central bank dealer.
But I got it. Fuck.
Range day, trades down into the bullish order block here, then finds momentum to trade higher, and then we have the scenario we would expect to see price move higher on a bullish discount PD array, and the same thing here, continuing up, looking to close in our gaps over here, which we'll look at in a moment. So when we have this range here, price moves into a projectionary state up 2 standard deviations. What you do is you take that range, and yes, I do all this by hand. Okay, so we have our range, and you just lay that on the bottom
I fucking knew
of
it.
the central bank dealer's range, and you start layering them down.
Oh, I didn't know
On that
that.
control, drag your image away, click on it, and drag away with the control button held down. There. Okay, so we have to blend 2 things now, time and price theory. So we're looking for this whole range of 2 standard deviations projected from the central bank dealer's range low. So it's going to be a bearish day. We have 1 standard deviation of the total.
Whoa.
What's that?
I just built a budgeting app in Base 44.
Guys, Nina just built.
Standard deviations used for the central bank dealer's range to call the high of the day. So we have 1 of those standard deviations, 2 of those standard deviations, 3 of those standard deviations. Why am I doing 3? Is because price kept going lower, 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 lower until we get to the time of day right in here. Okay, so I'm going to draw a vertical line delineating the beginning and the end of the London kill zone, or London close rather. So this candle closes it at noon, is 11, and it starts as early as 10 o'clock in New York time. Okay, and we have this projected low. So I'm going to use this line here. And yes, the charts will look a little bit busy for a moment. And we'll project this out in time. Okay, so we could take profit here on this day. The low comes in at 124.76. The close on that candle stops right at 2 standard deviations of the central bank dealer's range. Right there, you see that? Boom, hits it. Okay. Yes, it wicks down a little bit more, and I'll let you see it. A little bit more than that, but not by much. Okay, and now we're going to look at the 1800, which is the cap of the day. There's the low, and there's our projected low right here. 124.40. We called 124.41, so I was off by 1 pip. Okay, so time-wise, we looked for it to occur here. It just fell a little bit short, but it had to go 1 more standard deviation because it kept drifting lower. So there's nothing wrong with just taking profits here and leaving something on for the rest of the day, because there's a discount PD array of a bullish order block down here that we saw in the previous slide. That would be your objective. But you can take profits time of day wise here with 2 standard deviations of the central bank dealer's range, 2 standard deviations used to make the high of the day. So again, in summary, we're taking the total range used of all the standard deviations, 1, 2, 3, counting the central bank dealer's range always. So we have 3 of them. So we get a mock-up of that range and then project it from the low on sell days. Here's 1, 2, 3, and it gives you the projected daily range low. Okay, I'm going to take this off. Okay, Okay, and we can't do anything with this one here. We'll have to wait, get new information. And the next day here, we have our criteria here where it's a small enough range, essentially my dealer's range, to do 1 standard deviation down. Why are we going down 1 standard deviation? Because we have the bullish order blocks in here and an old bullish order block back here. Price trades down into it, clears out even the rejection block, which would be the bodies of the candle, sweeps through that in London, 1 standard deviation, misses it by 2 pips. Okay, so this is going to be a time where you just don't get it exactly, but it's still calling 1 standard deviation. So we get a range, okay, of these two together. So what you do, I'll borrow this. Okay, and I'm getting a measurement of that total range. It's almost the same thing, actually. It's pretty interesting. Okay, so we have 1, 2. Okay, 2 projected standard deviations up. That gives us a projected high. And I'm going to tell you why I stopped here before you start thinking, oh, you're cherry picking. Okay, so we have the projected high called here. Notice that this wick right here goes through our projected idea of where price should go. But this one stops right to the pip. Here's our time window when it starts on this candle. So it's a little bit early, 1 hour early, making the, well, not 1 hour early, but in the 9 o'clock hour of New York time, it made the high of the day. Then 10 o'clock, it made this candle's high, 11, and then noon here. Why did it go up to this level here? Forget the time element because you're never going to have that perfectly, but it just gives us a ballpark figure time-wise when they anticipate the move to unfold. But I want you to look back over here. We have a candle, makes a low, and the close comes off that low by a little bit. And then this candle opens, trades up a little bit. So all this buy-side delivery vacancy, okay, or void of buy-side delivery, it's only sell-side delivery, begins at this candle's low, okay, at 125.26. So from this candle's high here at...
Most traders fail because they're looking for too much. At 20-minute traders, we focus on one predictable.
25.03 to this candle's low at 25.26. We have 23 pips of range to close in right up to this point here. So we can look at that like this. Here is the fair value gap that needs to be closed in. It does it right there and goes just a pip or 2 above it, closing in this fair value gap from this high to this low. So it closes that in. So there's a reasonable expectation for us to take profit there because we want to get out early anyway, but that's why it went to that price point using the PD arrays. Okay, so nothing's changed. There's no no hocus pocus. It's all stuff that you've learned, but now we're applying it with great deal of precision and using time elements.
Tying together.
So we went 2 standard deviations up. If we would
So
go
beautiful.
3,
knowing what I know,
we went 3 up. That would took us up to the
Or-
bearish order block. But we were getting close to the time window. So while we could have expected this to occur,
have seen.
2 is about right because we're going to
I don't
fair
really
value
know
gap
it
as
yet.
we were running up here. And it became late in the day on New York
Okay, I kind of know it.
for London close overlap. So that's why we'd expect to see price peter out at that point. Again, here we have 2 standard deviations down. It goes right to the pip. So we get a measurement of this entire range of 2 standard deviations for that particular day. Okay, so we have our range defined.
But I can't wait to do this shit. Matter of fact, might as well do it right now.
1 and 2. Okay, so we have 2 potential standard deviations up. And also, when price trades down 2 standard deviations, what we're actually seeing is it trades down to another discount PD array, which is these 3 consecutive down candles.
2 p.m. to 8
Extend this
p.m.
over, and we'll see the overlap. Boom. Okay, so price trades down, hits it,
That would be
The opening on this candle is 124.36.
14 to
The
18.
low on this candle is 124.36.
14
Precision.
to 18.
Two
Right.
standard deviations.
Too
Okay.
too
And
big
as
of a
general rule of
range.
thumb, I like to always throw 2 on just to see what would line up.
18.
So on the first one, we see price
Perfect.
could reach up to this fair value gap in here.
18.
So this candle high and this candle low, we left a little bit of sell side delivery only, so there's a buy side liquidity void
14.
that we can see it trade up into. It's more specifically this candle, not this one, sorry. This candle here. So we can look at that, frame that out here. Okay, so on this day, price trades up. Here's the noon close of London. This candle right here. Trades up, closes in to the bearish order block. It goes inside of the second deviation. So while there still may be some range permitted based on the projections, it's the PD arrays that call the shot. Okay, it's not the magic of these projections. These projections will lead you to an overlap of time and price. So we're looking at the extension of the range, 2 standard deviations, measure that projected above from the consolidation of the central bank dealer's range high. We place that on there. 1 standard deviation, that alone would have been enough. And you could have took profits right there. And that would have been fine. And just left that little piece on there for the fair value gap to fill in and let the rest of the people chase that. The second one, you can have a little piece on still.
What are not
Once it closes in the fair value gap again, you would take another portion of your trade off and see if it has any room to trade higher. Ultimately, it never does, but that's the way you'd use it. In other words, you read from the London close, kill zone, London close, kill zone, London close, kill zone. The standard deviation range from the central bank range protractionary state. In other words, how many standard deviations does it go up? That's your key. Okay, that's the thing that makes IPTA reach for it. Now, it will go those many blocks down until it reaches the time of day where we expect the range to cap. That means if it's a New York session reversal, like we see here. Now, we're not using the range here because the central bank dealer's range is too extended. But price trades down into a New York session reversal because it hits a daily bullish order block. And then that's our weekly low. And then price has a slightly bullish day intraday on the next day. And then we have our setup going into the rally on March 30th.
We're one of the top-rated fencing companies in the state, and while I tell you about this month's special, I'm going to show you a few of our recent fencing projects behind me. This month, if you are interested in a new fence, we are taking a full 60% off the cost of installation, or you can get 60 months of 0% interest financing. Also, all these fences come with a lifetime warranty, so you never need to worry about this fence again. If this is an offer that's interesting to you, if you'd like to get a new fence like this one right here or this one right here, you can click the button below. It's going to take you to a page with a few quick questions, answer those, and then we'll reach out and we'll see if we can help.
Let's see if we get it. Not even look at it.
Are you still searching for a prop firm that puts traders first? Then you should be with Atlas Funding.
Trading down into a rejection block, bullish order block overlap, and then 2 standard deviations up, nails it. Now, we didn't get the exact range high in here, but using the fair value gap in here, it would have got you real close, 2 pips away from it. So you can't argue about that. Sometimes you're going to be right to the pip, sometimes you're going to be just short 1 or 2 pips, and other times it'll be just maybe 5 or 6 pips above. And there's nothing wrong with leaving a little bit of that on the table. And if you're looking for that always, I'm not going to be able to help you with that measure of precision. So by blending these things like this, it gives us an overlap of central bank dealer's range,
It gives us
projection,
a standard deviation to the
let me
upside.
remind you that the precision really is on the entry side of the low on the buy days and the high on the sell days. That's the standard deviations tactic. Now,
Might even take
where
this.
this will get you in trouble is you're going to try to apply these standard deviations based on the range between 2 o'clock in the
if it gives
afternoon
another
and
standard
New York time.
deviation.
You're going to try to do it every single day, and you're going to forget about the importance of having a range between 20 and 30 pips for the central bank dealer's range. It has to be less than 40, and you have to have a directional bias. Remember, we were in a premium up here. We saw price coming down to a discount PD array. This is the bullish order block. reasonably expected to bounce. Bounce it does. Okay, so to get into buy side.
So this will be my
Boom, one standard
my
deviation. Now I
projected
could have
swing,
done 2 standard deviations,
which goes back
okay,
into my
and trade down below
original
this wick.
prediction.
Could've
It
done
ties together.
that. But it
I
already
fucking
hit
love
this
it.
order block, and we found this low in here. The body's equal in here. We
So I would
swept
take
it.
profit.
Didn't get quite down there, no problem, big deal.
Half.
Even if you missed this move, look at this one here. You make up for it the next day.
I could take right here.
Is it a trade every single day?
My
No.
my
That's what I'm trying to show
TP
you.
already takes
By
it.
sitting down with you every single trading day and using the things that you've learned thus far in the order that you've been learning them, you can see that it doesn't equate to getting money every single day. Now, some of you are in here using other tools and using things of your own. You're in your own discovery of my tools and such, and you're able to find some setups. That's fine. That's great. But when we do live sessions, I don't want folks trying to call out what they think is going to happen unless I'm specifically asking you, because I'm trying to keep the learning curve, basically everyone in the same mindset. Because if I can hold you all collectively as long as I can in that mindset, you'll hopefully learn in the closest way possible, step by step with each other. And some of you are a little bit more advanced because you've been using my stuff a little bit longer than the mentorship started, but a lot of us are in here are talking for the first time, and we're using the content, in a gradual modular state, and this is the way you learn it. So by blending these things, again, this has nothing to do with Elliott Wave. It doesn't have anything with supply and demand. It's all interbank delivery. Okay, so this is the science, if you will, behind IPTA, calling it daily high and low. Please understand that this is something that should not be out there on YouTube. If you see this on YouTube, send me an email at innercircletrader@gmail.com. Tell me it's on there, send me the link, and I will flag it and have YouTube take it down. None of you have permission to post this anywhere, and I certainly don't want it posted on online video hosting mediums or made available to other people. So this is too good to be out there in public. I debated whether or not I was even going to include this, and I would have kept it out. You never would have known it anyway. But you would have missed how I pretty much call in the highs and lows when there's specific times of the day and times of the week and
You
times of the month
motherfucker.
where it lines up. This is how I do it. So hopefully you found this insightful. I'm sure some of you are going to be nuts about it, go through all your charts, and this weekend will probably be a very light sleeping week, but I can assure you that this isn't all there is. We get a lot more precise than this, but there's some things that you have to take in consideration. Obviously, if I gave this on a YouTube video and mentioned all the things that we've learned so far in the mentorship, it still wouldn't serve many people because they would try to overuse it. They would try to use it every single day. They wouldn't understand the PDA rate matrix. They wouldn't understand the IPTA data ranges. They would just not have all the insights that you have. So again, this gets back to why it can't be done in a video. It can't be just one video that does it. You have to have all the stuff that's been taught thus far, and now you can see how they start to draw together, and there's some symmetry here. So now because we are understanding these ranges, we can take our precision a little bit more further and now start to understand when we don't really want to be taking specific day trades. So now instead of trading every single trading day, while I will be forced to try to do it, I will remind you based on these rules that there is or is not a high probability setup based on the central bank dealer's range being in an area of discount or premium, and we're not in a range that is conducive. In other words, 2030 is ideal in terms of pips for the central bank
Yesterday
dealer's range.
was not a good
If it's
trading
bigger than
day
that, we have a harder time getting these measurements.
because the central bank
Because remember,
range
it goes
was
back to
too
power three.
large.
Average daily range is about 100 pips, not always, but generally, and we look for an average of about 33 pips for a protractionary state in London. It doesn't have to do that. It can be just 6 pips, okay? But generally, we allow up to 33. But if we have a central bank dealer's range that's greater than 40 pips, it usually messes up the synchronization for the London Open kill zone. So hopefully you found this insightful. Please do not share it. Please don't be your best friend to somebody else and give this out to someone. Keep it to close to your vest. Don't share it. Trust me, it's just way too good to be out there for everyone else to know. You paid for it. Be greedy with it. There's nothing wrong with that. You earned it. Until next lesson, I wish you good luck and good trading.
This single $100 bill into $100,000.
The fuck up. Mr. Gatekeeper.
Was of a very high time period. So larger, but then shot one kill. You're broke. Projected up. One have a mean it can. Higher or lower, and demand specific to many times London close can be incorporated as a entry point for longer term one shot one kill, or bounce around, go sideways, or it may catch you in a reversal that you weren't expecting, and it's just better just to just sit on the sidelines and don't worry about it. Wait for another trading day. London close. Now I've taught London close day trading strategy in the past. I used to do it, and I lost interest in it because it just doesn't give me enough of a payment, if you will. I'll touch briefly on it this month, but obviously I have my own teaching on it where you can watch that in my free tutorials. But nonetheless, London close is the time of day where we look to really bank our positions, and there are times when if the market is in a reversal intraday, but it goes down into a logical level of support or trades up into a logical level of resistance, that may be the very moment in time that a reversal occurs. London close is not always just simply close existing trades and move to the sidelines. Many times London close can be incorporated as a entry point for longer term one shot one kill, or swing or position trades. Alright, the New York close is basically just a time window. What we're looking for is the 2 o'clock hour. Now, I'm not going to argue that everyone else around the world is going to say New York is, later in the day than or and the lesson of a payment, if you will. I'll touch briefly on it this month, but obviously I have my own teaching on it where you can watch that in my free tutorials. But nonetheless, London close is the time of day where we look to really bank our positions, and there are times when if the market is in a reversal intraday, but it goes down into a logical level of support or trades up into a logical level of resistance, that may be the very moment in time that a reversal occurs. London close is not always just simply close existing trades and move to the sidelines. Many times London close can be incorporated as a entry point for longer term one shot one kill, or swing or position trades. Alright, the New York close is basically just a time window. What we're looking for is the 2 o'clock hour. Now, I'm not going to argue that everyone else around the world is going to say New York is, later in the day than that. I'll leave everyone else to believe whatever they want to believe, but what we're looking at is the 2 o'clock hour, and specifically the 3 o'clock, which is the close of the bond market. That, to me, is the close of the New York session. So what we look for is in days that have FOMC, interest rate stuff that comes out.
Imagine being able.
Wisconsin's families are underwater.
The new way to own your brand with Wix Harmony. Create a
measurement. What are we saying here? Between 2 p.m. and 8 p.m. New York time, regardless of where you live, those bullish candle right for the down move here at 25.03 to this candle's low at 25.26. What we have here is the market showing us 1800, 2 o'clock in the afternoon. Midnight New York, 2 o'clock in the afternoon. Midnight New York, 2 o'clock in the afternoon. Okay, and I'm going to give you the London kill zone reference points now. And this is that daily premium PD array here. So price trades up into it. This is the middle of the London kill zone close, and then we have London close of long-winded day in New York. That's the time of the day. So I'll dribble down or run up here. Wicks is it still stay here? Price trades down into that on this big central bank dealers range day. Trades down into the bullish order block here.
Okay.
Hey folks, welcome to lesson 5 of the April 2017 ICT mentorship, ICT day trading model. This teaching is specifically dealing with intraday market profiles. Okay, intraday market profiles. The first one I'm going to go over is the sell profile, London
shit.
normal protraction.
Nigga goes crazy, bro. Nigga has intraday market profiles.
And what you want to be looking for a classic sell day for intraday trading, there's going to be lots of different DV.
I feel like this is really important. So I'm gonna go to bed, rest, continue tomorrow. Maybe go through some of this information at work and then come back and refine it here. Something along those lines. Yeah, very, very interesting shit. I'm gonna let that run too. And see you guys tomorrow. Yep. Alright, bet. Where is it? Stop streaming.